I would like now to invite to the podium my old friend Adam to finalize a set of contributions for this presentation.
Thank you. Thank you all very much for coming out, and a particular thank you to our friends and partners at Moody's, the Marhoning, and the Moody's Deutschland group that put this together logistically, and my good friend Lucio, who is a European but is objective about it, so it's very nice. It is a disappointment, I'm sure, for everyone that you're getting me instead of Sandrine Duchesne, and I'm sorry for that, but I will try to make up for that with some other means we'll figure out later. Should we really care about global imbalances? This is a multiple part question. Should we care in general? Should we care if you're a voting central banker? Should we care in some conditional way that not every surplus or every deficit is the same? Should we care differently from different countries or different kinds of economies? And, every once in a while, someone stands up and warns you that global imbalances are a first-order problem. Governor Hanahan, as an academic colleague in Dublin, had Philip Lane, who spent most of his career, a very distinguished career, trying to convince us that global imbalances are a terrible thing and creating data for that. My predecessor as president of the Peterson Institute, Fred Bergston, took it one step further. He kept predicting a crash and hard landing for the U.S. because of the U.S.'s repeated global imbalances. And every time the crash didn't happen, that was just terrible because we were giving more rope to the U.S. to hang itself with the global imbalances. My former colleague, Paul Tucker's former colleague, Mervyn Lord King, has both while in office and since very clearly stated that he views global imbalances as the sort of background problem and cause of the great global financial crisis, and that we're making things worse in the sense that Patrick alluded to, although didn't endorse. And our friend Martin Wolf basically said as well, this is the great problem. That's all wrong. Okay? There is a reason why Patrick gets up in the morning and doesn't spend his time worrying about global imbalances. There is a reason why President Rosengren's colleagues at the Fed, despite having the services of Steve and his team, do not spend their days and the things agonizing over the U.S. trade deficit. It is very nice among the many distinguished press in this room to write about a currency war and to quote Secretary Lew, trotting out again the notion of one global engine, and we can't fly on one global engine. But it's just too much drama, okay? If you look back at the history of the last 40 years since the breakdown of the Bretton Woods system, what you find is the number of current account crises that occur in large countries with their own currency, or large economies, let me say, with their own currency, is basically nil. My colleague Joe Gagnon has written on this, others have written on this. And so then among those places where you have crises and problems, you have to ask yourself, how much is the current account balance itself the driver, and how much is it mistakes like, borrowing mortgages in a foreign currency, having a current account deficit because you run a huge federal government deficit. By the time you start parsing this down, there's a very limited number of cases. They do exist. But the number of cases where global imbalances in and of themselves are a major problem is very few. But I think the most important point is, I and many others spend a lot of time pointing out where the academic literature is wrong in macroeconomics, partly because it gives us something to do, and partly because things really did get wrong the last few years. The fact remains, this is an area where I think the academic literature is right. If you go back to the literature on global policy coordination, go back to the game theory work of Hamada, go back to some of the empirical work that Jeff Frankel and others did, you find a lot of support for the basic idea that if you're a large economy, the best thing you can do for the rest of the world is to keep your economy as close and stable to full employment. And when you start adding in the kind of financial spillovers that Steve Kamen mentioned, that becomes even more the case. And nothing we have seen in the last 5 to 7 years with the use of QE in any way changes that conclusion. We have all this going back and forth. Brazil is my favorite punching bag of the moment for good reason. And the Brazilians would come out and they would say, the U.S. is driving us crazy with this beggar by neighbor QE, and our currency is getting much too strong. Meanwhile, they have a booming economy. And then they say, oh, the U.S. is driving us crazy because they're threatening to tighten, they're throwing a taper tantrum, and meanwhile, they fall in the end of the commodity cycle. And like every other ex-post ad hoc explanation of exchange rates, it's just a way of blaming somebody else for your own problems. And it's not clear to me now that the transmission of monetary policy to emerging markets, the spillovers that Steve talked about, are discernibly different under a QE regime or a QE method than they were in the past. What has happened is because of the G20 process and the relative shrinking of the U.S. in both economic and political terms, is the Brazils and the Indias and the others can complain more loudly now, or at least get more heard, when the same thing happens to them as happened during the Volcker up and downs. Moreover, just to stress my main point, the Volcker up and downs occurred because the U.S. ran a very poor domestic economic policy for several years. And therefore, it was necessary for the Federal Reserve to engage in extreme action. And had the U.S. not engaged in these terrible monetary fiscal combinations in the 70s into the early 80s, there would not have needed to be that, and there would not have been those spillovers. So, is this going to be any different for the euro area? I mean, to be very clear, we are holding this conference in part to get at the reality of quantitative easing. The European Central Bank, I believe rightly, has taken its historic step to actually live up to its mandate and do something about deflationary trends. And they're going to, as Patrick indicated, they're using QE. Is the kind of calm scenario I'm saying that we shouldn't be worrying about the overall impact, the currency war aspect, all of this, is it different for the euro area? Is it different for the euro area for some structural reasons? Is it different for the euro area because of the nature of the euro area QE? Now you can guess what my answer is. The answer is no. But let me try in my remaining couple minutes to explain why I don't think that's the case. In the end, when you're evaluating the cost-benefit of quantitative easing, as Paul Tucker and I tried to stress while we were at the Bank of England, and others have tried to say, it's not enough simply to do the counterfactual embodied in a DSGE model, like Steve was talking about, even though understandably that's where a central bank or a researcher would start. It's you have to be looking at the fact that you are potentially switching between regimes. You're switching between a state of affairs in which you are in a very bad outcome, it's a very sticky outcome, it's an outcome in which the central bank's policies are seen as broadly impotent, to a regime of potential recovery of central bank policies having some effect. And of course, the example in the back of all our minds, as it should be, is Japan. And so the issue for the central bank, the European Central Bank, is not that you're in deflation right now. It's that on reasonable forecasts, absent European Central Bank policy, you would have been in an ongoing deflationary era. And that if you tried to make up for it with monetary policy, once those expectations and once those behaviors got anchored, as was happened in Japan, you're not pushing on a string, you're pushing on a very, very, very heavy cable uphill. And it makes sense for a central bank that has a price stability mandate to get out ahead of that. And the alternatives in terms of financial stability and within the euro area, cross-country, cross-party financial and fiscal risk are so large that it's important to put that floor under things. And that was certainly true for the US undertaking QE in 2008, 2009. It wasn't about, oh, are we just calibrating monetary policy or are there these things? It was, as my colleagues who were sitting there at the time, no, it was about preventing from getting into, in the euphemism, a bad state of the world. The second thing that I think is important, this is a place where I do want to distinguish myself from Patrick and from others, is I am really, really sick of this term unconventional monetary policy. And Patrick switched it up and he used the term non-standard monetary policy. I don't care which of these phrases you use. They are fundamentally misleading, and I think central bankers have caught themselves in a corner on this. There is nothing strange about central banks buying and selling large quantities of assets. There is nothing strange about central banks buying or selling even private sector assets. If you look at the history of central banking up until about 1970, that was what they did. You didn't have a world in which you had this well-behaved forward federal funds curve and did everything by signaling a little bit on what they were going to do with 25 bits. It was you had people sitting at discount windows actually making decisions about how much to buy and sell in particular assets. That's what central banks always did. And so it may be nicer in some apolitical sense. It may be nicer in a sense of moderately more predictable outcomes to have the notion that there's this great thing, we can move interest rates up and down, or instrument interest rate goes out the yield curve goes out to the economy, one asset's all the better, isn't this great? And we can even describe it in a Taylor world. Wow, great. It's all very nice, but it's not necessary. And it's really just a convenience that happened to coincide, understandably, with a period of particularly benign conditions in the world. And so when we keep using this term, unconventional, non-standard, all this, we are simply feeding a false notion that there's something dangerous or different with QE, for which there is no basis. Now, there remains in the background the question of beggar thy neighbor policies. Are we somehow seeing Europe or Euro area export deflation and unemployment elsewhere? Are we seeing China potentially do that as they've done in the past? And I think the answer is yes, to a small degree, but that's life. Now, again, this is a point at which people have different opinions. My colleague Joe Gagnon, as many of you know, has written at great length about foreign exchange, what he considers manipulation, and believes this has a material effect on well-being in the U.S., particularly in times of recession. And it's an intellectually interesting point of view. But I think it's fair to say there's a reason why successive U.S. presidents and Treasury secretaries and Federal Reserve chairpeople have come out and basically said, we're big, we can take it. It's as long as we're not in the absolute depths of a major recession. That's part of what we do to keep the world going, and we want the world to keep going. I don't want to make the U.S. sound terribly self-made. I think this is the classic hegemon, public good provision in the Mansur Olson sense, that the U.S. provides this public good because in the end it's worth it enough to the U.S. economy and to the U.S. leadership that it's worth it to them, and it's not conflictual. That's why it's a public good. But I think it is very interesting, and here's where I'll start to close. I think it is very interesting to consider that if it's difficult for someone to say that Europe or China or the US in previous were doing beggar thy neighbor to people in Europe, at the same time when it's truly Germany that's doing beggar thy neighbor to its neighbors within the Euro area. And if we know one thing within economics, it's that if you put large imbalances within a horribly fixed exchange rate system and you allow no adjustment, that does export deflation and unemployment, which is of course what has happened to Ireland, to Spain, to Italy, and especially Portugal and Greece. And so, if anyone cares to worry about imbalances, It would be far better to think about the imbalances that remain and, if anything, have increased within the euro area, and which are then providing the both political and financial risks that are spilling over to the entire world economy in a material way, than to worry about these second-order exchange rate effects of large economies. And that is in everyone's interest. It is very interesting to look at our friends in Switzerland. Our friends in Switzerland, all I talk about exchange rates on is obviously if you're a small open economy, life is hard. Okay? Sorry, it just is. That's why the euro area exists, right? So you're not all a bunch of small open economies getting beat up all the time. If you're Switzerland, you don't have any good choices, okay? You didn't have any good choices 2.5 years ago. You don't have any good choices now. You especially don't have any good choices if you insist on making your country a major financial entrepreneur. That's your trade-off. If you chose to shut down or shrink the balance sheets of your banks, you might have less inflows, you have less of a problem. That's up to you, okay? However, I think the most important overlooked lesson from the Swiss case is that running a huge surplus isn't all that much better than running a huge deficit. Switzerland got these huge inflows. It led to distortions in the economy. It led to underinvestment in the domestic sector. It led to rises in salaries with no rises in productivity in the non-export sector. It led to overinvestment in the export sector. It was not cost-free to run a huge surplus. And if Germany and others insist on doing this in the future, they will soon find out, as they already have, and as in a sense Hans Werner Sinn has argued, a hollowing out of the domestic sector and a distortion of investment and a diminution of investment for the long term. So global imbalances, don't worry about it. QE, not anything special to do with global imbalances. Imbalances within the euro area, that still matters. Thank you very much.